Hello, everyone. Welcome to another interactive session by AKC Capital. Aditya K. Chopra here, founder and CEO of AKC Capital. It's a pleasure to have with us Mr. Vikaas M. Sachdeva, who is the Managing Director for Sundaram Alternate Assets in India. Today, we'll be covering certain views and topics on alternate assets. But before we start, maybe to Mr. Vikaas on his background.
Okay, so I'll make it very brief. I think it's been almost 3 decades that I've been in the financial services industry. I started my career, first few years was in merchant banking, which is now called investment banking. My tryst with investment management firms started with Birla. I'm one of the founding members of Birla Mutual Fund way back in '95. After that, I worked with a clutch of organizations like ING, like AXA, and my first, first endeavor as a CEO was when I took over Edelweiss Mutual Fund. So I took it over in 2010, and by the time, and it was maybe a double-digit AUM at that point of time.
Right.
And by the time I moved out in 2017, we were not only the company which had broken even at the lowest AUM in the industry, but also had taken over JP Morgan's India assets.
Yeah.
In 2017, I moved to the alternate space.
Right.
I was the global CEO of Inam Asset Management for a couple of years. And then I had the privilege of working with MK Investment Managers, where I learned the ropes in terms of AIF.
Right.
And here I am in Sundaram since December 2022. So this is what my background is. It's a privilege to be here. Aditya, I've heard a lot about your shows. I've caught a few snippets once in a while. And I look forward to this discussion. Thank you so much for having me on your show.
So thank you so much for your time and, for your time for the show. I think for our viewers here, what we'll be doing over the next half an hour, 40 minutes is to cover certain queries on the emerging alternate assets landscape. And we'd look forward to your views on the same. Right.
Glad to be a friend.
So my first question to you is that if you look at the number of HNI, ultra HNI clients in India have grown steadily over the years. So how has the alternate asset landscape changed? And how do you envisage this change in the next 3 to 5 years?
It's a very interesting question. And, if I have to just step back, I think there is always a context when you see growth.
Right.
It doesn't happen out of the blue. And I think the context is basically the per capita income of Indians crossing $2,000.
Right.
See, a lot has been written about how the average person in a country, when the per capita income crosses $2,000, how the food habits change, the consumption habits change, your lifestyle habits change. But very few people talk about the investment habits changing.
Right.
Okay. You have a population now which is far more informed, a lot more wealth, far more informed about what's happening globally. Okay. And want to partake of that growth.
Right.
By virtue of the fact that you are starting to have more disposable income, your propensity towards long-term investing starts getting built in. And correspondingly, your ability to take a little bit more risk starts coming in.
Right.
Just to give you an idea, the number of HNIs, when China crossed $2,000 per capita income, I think way back in 2008, the number of dollar millionaires at that point of time, which we classify as HNIs, was around 4.5 lakhs.
Okay.
So 4.5 lakh dollar millionaires in China. In 2020, when India crossed a per capita income of $2,000, the number of dollar millionaires is in excess of 7.5.
Really?
And it's expected to double in the next 3 to 4 years.
Right.
So by virtue of the fact that you have an increasingly aware population, more disposable income, they are seeking out assets. Now, what you will also find is that there are some very specific requirements they want.
Right.
2 specific requirements, or rather 2 specific tenets on which this entire thing is built is capital preservation and growth.
Right.
An HNI, whether he operates through a family office or on his own, will always want to preserve his wealth and grow, which means that he's open to taking risks, but not disproportionate risk or uncalculated risk.
Right.
Okay. Which is where the whole alternate space comes in. Okay. Alternate space today will provide, and I'm saying alternates includes PMS and AIF, will provide more curated portfolios, more customized sort of investment options, and the ability to look globally.
Correct.
So what is not conventional is alternates is the general definition of alternates.
Correct.
And I think that is what HNIs and ultra HNIs are starting to realize. There was a survey done a few years ago in which the average HNI,
Right.
around 5% of his money would have been parked in alternates. This was, I think, around 4 years.
Right.
It's already inching towards 15%.
Okay.
Okay. And it is estimated that the number of people who invest between 5 and 15% of their money in alternates over the next 5 years will be 50% of the piece.
Really?
Yes.
Okay.
And these are all data points which, you could have a look. It's in the public domain.
No, I think these are interesting insights. And I think a clear point that is coming out, what you're saying is that as new wealth creation happens over time, probably a lot of the new rich clients, ultra-rich clients, are also looking at differentiated product offerings. I think that's a key takeaway here. And obviously, you look at the growth in numbers. You've been talking about average from a 5% allocation, and we're seeing that it's going to around 15%, and then even eventually, as you said, some research points even to 50%.
So 50% of the population in the HNI segment, 3 years from now, will put in between 5 to 15% of their money in bare minimum.
Bare minimum. So I think if I have to look at from an asset allocation, you're seeing a 3x growth from 5% to 15%, which is a huge growth potential in this
it is going to be multiplied by the number of HNIs themselves growing.
Absolutely.
This is on an increased base.
And that's all the reason why we need to probably look at this space over the years as we go forward. So my next question is, when you juxtapose this with the global scenario, do you see a similar trend, and how do you see that over the next couple of years?
It's a very interesting question here. So if you're talking about global trends, see the global savvy money, I won't call it HNIs or ultra HNIs because typically they could be hedge funds where HNIs and ultra HNIs invest. The global savvy money always tries to hunt for either higher alpha or a lower cost.
Yeah.
So it started a few decades ago with active management. Then it moved to passive management.
Right.
Okay. Then it moved to private equity. Okay. Probably it's moving towards private credit at this point in time.
Yeah.
The whole hunt is for that additional alpha, for an additional amount of risk that I'm able to take. Can I get an additional alpha? Is where this whole money moves.
Right.
And it has spawned a variety of solutions across a variety of asset classes. So not only is it equity, but you have real estate, you have commodities, and you have different types of products which are out there. Typically, you will find that the growth, the way it is moving, most of the growth now is starting to happen in the alternate space. Not only is the trajectory of growth faster, but also the per unit profitability in terms of an alternate product is higher. Okay. And I think that is where we are also moving. Okay. So if you look at the trajectory of the Indian HNI, he's also moved from active to some extent to passive, went into private equity, and now if you're seeing private credit as an asset class coming up, there are opportunities which are coming up in the country. Also, what is happening is that some segments have opened up. For example, in private credit, what used to be the domain of banks a lot earlier, banks are now very heavily regulated. They can't lend, beyond certain restriction.
Right.
Move to NBFCs. But after the ILFS crisis, is actually moved a lot towards AIFs. So what you're seeing now is a platform like in AIF. I'm just giving private credit as an example. A platform like in AIF, which is funneling in HNI money, family office money, into the growth of the country, into the segment where people actually need money, which was erstwhile serviced by banks.
Right.
So this could be 18 to 24 months money for certain growth plans the promoter has, which is being fueled through this entire thing. So I think this has been something which has been there overseas. It's just happening here. So much so that it is assumed that the private credit opportunities, and I'm using private credit as just a leading indicator, close to $50 billion worth of opportunities will come up in the private credit space in the next 5 years to funnel this growth.
So that's a big number you're looking at.
It's a big number. So if you have to become a $5 trillion economy, almost half of it has to get funded through avenues like private credit, and this is a very important vehicle.
Great. I think that's an interesting perspective, and I think what we're trying to understand here is that somewhere what I could infer from your points is that this has been there a global trend as well. Yes. And I think India, as it becomes an emerging economy and then on path to become a third largest economy probably by 27, 28, I think this is just a natural way the country and the progression the country is going to look at. And that makes it all the more important that not only we become aware of this trend and try to devise strategies to make sure that we capture this trend, be it in the client's portfolios or even if you're looking from a product manufacturer perspective or from an advisor perspective, it's important to kind of be aware of this trend and
Absolutely.
look at strategies to capture this effectively.
Absolutely.
Okay.
Absolutely.
Great. So I guess, which brings me to the next question. I think this is an evolving landscape. And is that if you typically look at a HNI or ultra HNI client, especially looking at India, do you think that they should be looking at the alternates asset space as a investment allocation in the portfolios? Do you think it's important?
Well, yes, it is important because, like I said, if you go back to what does this segment want? This segment wants opportunities to invest in.
Correct.
Okay, and they will look for vehicles which gives them this opportunity.
Okay.
For example, if you're looking at the long short fund today, if you want to go short, you want to do a long short fund, you have to go to an AIF. If you're looking at a curated, concentrated portfolio of 12 to 15 stocks, you have to go to a PMS.
Correct.
Okay. If you're looking at, for example, opportunities in ETFs, in robotics, tomorrow that will happen through AIFs. Okay. So this is a segment which is very well aware of what is happening.
Right.
And ultimately, what are AIFs? AIFs are basically a closed group of around 1,000 investors. You can't have more than 1,000 investors who come in with a common objective. So if we have a space which is looking at a common objective, it could be pre-IPO, it could be unlisted stocks, it could be long, short, it could be a variety of things.
Right.
You could create an AIF around that.
Correct.
So from that point of view, I think, yes, there is quite a lot of interest. But again, one of the notions people have is that alternates is a substitute for conventional products. It's actually not. Okay. You first have to exhaust your limits, if you will,
Right.
in terms of investments in conventional investment avenues before you move on to alternates.
Right.
Okay. Because alternates, all said and done, is for a savvier audience who understands that it's a slightly higher risk, higher return product.
Right. Right.
So that is the way it is.
Yeah, and I can coming from a from a wealth from where we advising clients, ultra HNI clients on the portfolios. I think what you're basically saying is other nuances like the right asset allocation, risk appetite, the liquidity they need in their portfolio and the time horizon. These are important elements to look at.
Correct.
Before when you're considering allocation to alternate assets.
Absolutely.
And what I personally see is that returns is always one dimension of it, but you need to stitch all these components which I just mentioned and then make it as a suitable allocation to the client's portfolio.
Absolutely.
But I think, for the larger audience here, I think it's important that clients do look at the space within these constraints and look at and that way maybe they can get better risk-adjusted returns on their portfolios over a longer period in time.
So there was a study which was done by Morgan Stanley. Again, this is in public domain. Over a 30-year time frame,
Right.
they looked at the performance of different asset classes.
Okay.
So if on the risk return graph, you are moving from 100% bonds to 50-50 bonds and equity to 100% equity.
Right.
Okay. If you add 20% alternates, and they've defined alternates as hedged equity, they've defined alternates as real estate debt, and over a 30-year time frame, in each of these baskets, if you add 20% alternates, so for example, instead of 100% bonds, you put 80% bonds and 20% alternates, 40-40-20 in terms of the blended option, and 80% equity and 20% alternates.
Right.
Not only does it bring down the volatility, but it also enhances the returns.
Excellent.
Okay. And again, the study is in the public domain.
Right.
The key point is it's over a 30-year time frame.
30 time frame.
Okay. So alternates works, but it will not work like a magic potion in the short term itself.
Yeah, I think
ultimately everything is subject to what is happening in the market. You can't beat the market every
and I think that's a very important perspective for our audience as well. And I keep telling my clients also that it's always good to chase equities for returns, or alternate assets for returns. But at the end of the day, be cognizant of the time horizon and the time you want to commit.
Correct.
Right? Because if you don't have the time, then then it may not be a right investment, because for any alternate assets, generally you need to have 5 years plus time horizon, 5 to 7 years or 5 to 8 years ideally. And equities, we always tell clients to invest it for at least 3 to 5 years. So I think that's an important takeaway here. And obviously
it's actually a very important point you're mentioning. I should have brought this out earlier. It's actually the crux of this entire thing. The longer you invest, the more money you make is a norm. Right? But if you look at an AIF, typical AIFs are close-ended.
Yeah.
So if you're going to be sacrificing liquidity, you need to have a premium in terms of risk-adjusted return.
Yeah.
Okay, so that is the trade-off.
Absolutely.
For example, in a mutual fund or in direct equity, it's a fairly liquid product. In a mutual fund, you can actually pay an exit load and move out. In equity, you can trade. So the propensity to be locked in puts a lot of pressure on the advisor. The advisor has to constantly make sure the client stays the course. Right?
Absolutely.
Not in the case of an AIF.
Yeah.
Wherein you come in thinking you're going to be locked in, and you brace yourself, you plan your finances accordingly, right? So typically the returns tend to be a little better in terms of risk-adjusted returns over a period of time.
Absolutely. Yeah. Thank you so much for the insight. Which brings me to the next question with looking at is that when you look at alternate assets, generally, what is the average ticket size and how do you see that, evolving over the next couple of years? And also, do you think that there is adequate transparency in this industry? In fact, one of the key things which we keep coming across clients is on the regulatory and the compliance side, So obviously, if you look at India, SEBI is a regulator, but do you think, so my question to you is that when you look at the alternate space, do you think there is still room for further transparency, compliance here? And how do you see the ticket sizes evolving over the next 5 years? Average ticket size for an alternate asset?
It's an excellent question. So if I have to just strip away the institutional part of the money which comes into AIF and PMS, because that can be multiples of 5 crores, 10 crores, 20 crores, okay? That can be multiplied. If you look at the individual investor, I think in a PMS, the last time I saw a study, the average ticket size was around 58 lakhs.
Yeah.
Okay. And in an AIF, the average ticket size was 2 crores or slightly around that.
Right.
Okay. So contrary to popular perception that you get a lot of big ticket money, it's actually the average Joe, the average HNI Joe, okay, who's partaking a lot of this.
Right.
Okay. And that's something which has been brought out by data. So the corollary to this is, if that is indeed the case, and these are investors who are reasonably sophisticated on the sophistication curve, but not very sophisticated, what sort of information do they need to consume? What sort of transparency does the fund need to do?
Right.
Okay. Which I think is right up there. The PMS industry has been around for 20, 22 odd years. The AIF industry is around 10, 12 years.
10, 12 years.
Okay. A fairly nascent industry, but I think we've picked up from the best practices which other industries like the mutual fund industry have shown us. If you look at, for example, PMS today, portfolios are available on WhatsApp. If you're a subscriber, we provide portfolios on WhatsApp.
Correct.
Okay, and any other statement which you need. It's probably the most unbundled product that you can ever find.
Okay.
Okay, every single cost is laid out there.
Right.
On the AIF front, I think there's a lot which has gone in. The regulator is constantly giving us inputs in terms of how to make it more informative. So you see the quality of fact sheets which is coming in, the quality of disclosures which are starting to come in. I think it's all out there. I think as an industry, AIFs and PMS have proactively actually taken upon the responsibility of calling an investor once the investment is made on a recorded line, just to make sure that the investor understands where they're going. You cannot be more transparent than that.
Right.
I'm saying at the entry point, this is a moment of truth.
Right.
When a client comes in, he gets a call saying, are you aware that this is where you've invested? And we've done that proactively.
Right.
There is no regulation asking us to do that, right? So I think the transparency is there. It's moving increasingly, but you also have to realize that these are close-ended funds.
Right.
Okay, these are not open-ended funds wherein the disclosure level can be extremely granular.
Right.
Okay, because there are strategies at play.
Correct.
Given those constraints, I think my sense is we've come a long way. I've been seeing alternatives, especially in the last 5 years. The amount of disclosure, and you see, one of the things you have to realize is disclosure, if it is coming in from the regulator, people take it very unwillingly, and they always find ways to disclose a little less.
Right.
What you're finding in our industry, when there are more than 700 PMSs and 700 AIFs, it's coming from competition.
Okay.
Competition is saying, can I just be a bit more transparent? Can I show a bit more? Which sets the standard for everybody else.
Which is a positive trend.
Which is an extremely positive trend.
Okay.
And you're talking about 40 odd mutual funds, but 700 odd AIFs. You can imagine the intensity of competition here.
Absolutely.
And that is what gladdens my heart.
Okay.
As an investor, you get to see a lot more
Right.
than what you would have bargained for.
Right. Which brings me to the one question: is that average ticket size? So obviously, based on the study which you mentioned, it's like 2 crores.
Yeah.
PMS is 58 lakhs.
Yeah.
But do you see this average ticket sizes, the regulator increasing this average ticket size over time, so that to bring in a lot more, to weed off retail clients and say, okay, this is the cutoff, and hence maybe the investor has understood a little better than what it has been historically.
See, there have been, discussions which one reads about in the media, and SEBI has also been talking about that
Yeah.
as well. But the fact of the matter is that this is still a very nascent industry.
Very nascent. So,
Like I said, if you strip away the large ticket sizes, so just to give you another sort of in this thing, there was some survey done. I think there was a CANS report which had come up, in which there was how much do you depend on a distributor and how much do you invest direct?
direct.
Okay. So it turns out that in terms of CAT 3 equity, 81% of the money comes in through distributors.
Okay.
And this is despite trail commission now. So there is
Right.
no upfront commission.
Yeah.
Right. So you can see the importance of an advisor there.
Yes.
It's not something which is coming in directly from a customer.
Right.
Yeah. If it was, then you would say that the customer is savvy, so let's increase the ticket size.
Right.
Yeah. Here it's still dependent a lot on the investor. If you look at category 2, it's 50-50.
50.
But if you subdivide it into private equity and private credit, you will find private credit is a lot more direct.
Okay.
And private credit is a lot more distributor driven.
Okay.
Okay. So these are nuances. And you will have to understand that this is not a one size fits all.
Right.
Okay. So my sense is that we're into, this is very early days.
Right.
Let the average ticket size go up to 5 crores. I mentioned that there is going to be a lot of money coming in. So obviously money is going to be bumped up in terms of where you're investing.
Right.
3-5 years from now, there could be, a situation wherein we can sit around the table and say, okay, the average ticket size is now 4 crores. 4 crores. Right now, we're a very nascent industry.
Absolutely.
And ultimately, what are we talking about? 1,000 investors per AIF. It's a private placement.
Yeah. Private placement.
So it's not that we're going to attract money in hordes.
Right.
And suddenly everybody will start investing.
Absolutely. Thank you so much for your inputs. And which brings me to the next question. And that's on, last year when we especially, when we had the budget and the indexation was taken away from debt mutual funds, right? It was a kind of a big move for the mutual fund industry per se. Do you think that this move has been positive for credit AIFs in the alternate space? Because my assumption being that especially for investors who are chasing higher yield would probably look at these opportunities either in credit AIF and you're getting the same, you're still being taxed at marginal rate of tax. So do you think you're seeing a shift of money from debt mutual funds into credit AIFs over time, and is it a positive or how do you?
Very early days.
Very
early days. Just been on less than a year right now, maybe just around a year right now. Yes, there was this initial burst of money which did come in, but I think you use a word called asset allocation. Okay, in debt it is more of laddering.
Yeah.
In terms of where you want to park your money. Duration is still a very significant part of a client's portfolio, especially when you're talking about these noises around interest rate.
Yeah.
So I think a lot of money is in mutual funds where you can actually play duration.
Right.
Maybe some amount of credit money has come into private credit. Also, what has happened is this layer of indexation which used to benefit a mutual fund investor.
Right.
In my initial days, we were all about promoting indexation. We've been doing that since 1995, right?
I know.
And now suddenly it's gone. So
Right.
it took some time for people to orient themselves. There's a little bit of disorientation. But now each product is standing on its own merit. And each product is now coming into an investor's portfolio basis his risk appetite. So I don't think, for example, an HNI who would have parked 5 crores in a mutual fund will overnight park 5 crores in a private credit fund just because the returns are higher here.
Right.
He will still weigh the options in terms of tax, in terms of what is available to him, and then make a decision. These are two different platforms. And to my mind, over a period of time, while there could be some shift of money from one platform to the other, they will both exist in a very, very robust format.
Right. I think that's a very relevant input, and I think what I'm trying to understand here is that each of these product will have their own merits in terms of
Absolutely.
investment objective, time horizon, return dynamics, etc.
Correct.
And they will end of the day, the client's asset allocation will really decide how much the client really wants to park.
Correct.
And I think if I were to add one perspective here, each of these asset classes, mutual funds, you look at structured products, you look at credit, they have their own dimensions, risk reward dimensions. And I always tell clients, just to add on, is that when you're looking on AIF, then you're looking automatically at a time horizon which is of 5 years plus, 5 to 6 years. You're looking at higher capital commitment, which is 1 crore plus, right? You really can't compare it with mutual funds where your average ticket size is much, much lower, right? You could invest in multiple of thousands. And again, mutual funds have a duration play, especially now that this year we're looking at the Fed rate cut and probably rate cuts in the second half of the year. So I think for our viewers here, I think all investment vehicles have their own merit. End of the day, the asset allocation, and which would really decide the course forward.
Oh, absolutely. I think this is the crux. Also, one significant part is what is the playground which you have. Now, if you look at a mutual fund cannot go down below maybe AA plus.
Yeah.
If a mutual fund goes to AA plus, I think there'll be all sorts of noises being made, because this is essentially a retail vehicle and it's an open.
And you would want capital preservation and stuff.
Now, if you look at private credit, when you're doing the structured deals, very rarely would a AAA or a AA entity borrow from an AIF.
Yeah.
Okay, because there are other sources of getting money from, right? So it's a structured deal. If I'm lending money to a particular borrower, and if I were to rate him, it could be anything between A plus, A minus, triple B.
Right.
Right. But what we do is we basically have enough of security around it, and these are enforceable securities.
Right.
One of the key things firms like us have is basically an entire ecosystem. The DNA is credit.
Okay.
So if you look at Sundaram Finance, Sundaram Home Finance, they both are on our, senior people from Sundaram Finance and Sundaram Home Finance sit on our IC. They have serious skin in the game in terms of our own AIFs where they invest. So the sort of nuance they bring to the table, okay, is invaluable, because if you're going to be lending to a particular borrower just on the basis of, say, a perceived rating, it may or may not work for you.
Right.
But the information available about that borrower, because at some stage the Sundaram ecosystem would have evaluated it.
Right.
Enables you to put enough guardrails, enough security, so this is all senior secured debt, no pari passu, all those things which we are doing. So a lot of hard work goes into, for every 10 deals which come to us, probably one of them goes through.
Right.
So while for an average investor, it might look like, the Garden of Eden, that you're walking in and you're getting a higher return. To generate that sort of return and to mitigate that sort of risk takes a tremendous amount of effort.
Yeah.
Which is not possible in an open-end platform like a mutual fund, because you have SEBI, who will not allow instruments like this to come in. You have an investor who is not used to that sort of risk.
Right.
Okay, and you have a platform where you can walk on any day.
Correct.
Okay, I believe that the biggest antithesis of private credit is liquidity.
Right.
They're oxymorons. So you have to give liquidity away and get a premium in terms of returns.
Yes.
Which is possible only in an AIF.
Right. And if I were to summarize this well, and for our viewers here, I think the strength for Sundaram Alternates is the process of due diligence itself.
Absolutely.
And I think that's the key takeaway here, is that how you do the due diligence in terms of collaterals in place, how you select portfolio companies, the IC and the research element that goes into it. That, I think, is a lot more work which is going in the background. And I think for investors here, I think they should feel a lot more confident while they're allocating to Sundaram Alternate.
Like I said, there's serious skin in the game.
Absolutely.
The promoter companies themselves put in money.
Absolutely.
So everything has to be absolutely kosher, above board, clean.
Yes.
That's what.
Okay. So, which brings me to the next question in line with the alternate assets. And that would be that one of the debates is that, there's always constant debate between fixed deposits, debt mutual funds, and credit AIF. So do you think clients who traditionally are, have a lot of FDs in their portfolios could probably look at credit AIFs as allocation in their portfolios?
See, I have all three in my portfolio.
Okay.
To give you an idea, right?
Okay.
I think all three of them have their position.
Okay.
Like I said, it's not one against the other.
Mm-hmm.
All my life, I've been talking to people and saying that mutual funds are better than FDs.
Mm-hmm.
But probably there is a segment or there is a portion in your portfolio which only an FD can fulfill. Okay. It could be 3% of your portfolio or 2% of your portfolio, but it has to be there.
Right.
That is the instant liquidity which you will get. Okay. You don't even have to wait for 24 hours.
Right.
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 And then, of course, there are mutual funds and there is credit. So, I think you have to talk to an advisor. Basis your cash flows, basis your risk appetite, basis your requirements in the future is what you stagger this. My sense is that the FD part of it, where people go for, usually has to be very, very liquidity specific. It cannot be return specific. It cannot be comfort specific. See, comfort, when you invest, comfort is obviously more important than conviction. But it is the role of people like you and me to make sure that the right perspective is given so that the comfort towards the other investment avenues gets higher. People should not feel that if I invest in a mutual fund, I may not be able to pull out my money or there'll be a loss when I pull out money. I mean, I'm just saying that there has to be a proper orientation which has been to be given to them.
Absolutely.
So from that point of view, I am of the view that all three are important.
Yeah.
It is a proportion which is very, very important. Proportion is part of your asset allocation as well as your laddering in terms of a debt portfolio.
Excellent. And I think that's so much important, which we have reiterated, and for viewers, the right asset allocation.
Absolutely.
And I think one of the key learnings which, our viewers are taking from this conversation is that one size does not fit all, right? Every asset or every product, or rather say, would have its own risk-reward dynamics, its pros and cons. Really depends on what the client needs, as you kind of read. So have all depending and the right proportion, which is nothing but the right asset allocation.
In fact, it's interesting. On a different note, I should mention, if you read the newspapers today, there's a lot of conversation on IPL.
Oh, okay.
Now, each of these teams, if these were investment products, you could look at the asset allocation. So somebody is trying to bolster their all-rounder performance. They're getting all-rounders.
Right.
Somebody says my batting is weak, so I need to buttress that. Somebody is saying my local talent pool is very weak.
Correct.
So I need to buttress that.
Right.
This is all asset allocation, right? That is what they're doing. So ultimately, it results in a win or a loss. So,
yeah. And which actually, I always tell clients, just to add on to this, is that it's so much important that, we never look at products. I always kept telling clients over my 2 decades in the industry is that always have you quantify your financial goals and then look at products which are nothing but solutions to meet your financial objectives, right? If you do that, it takes care of a lot of things and avoids shocks in your financial portfolio. So the long term.
If I can probably give another message to your clients, I think if they work with people like you, who are able to deliver even an average return over an average period of time, so an average pipe, and pipe I'm saying like any platform or whatever,
right?
The tailwinds this country is going to give you will itself, give you a lot better returns. What you need to make sure is that the process is right. Whether it's asset allocation or whether it's staying the course. Most people look more at the returns,
right? And
then they change their asset allocation, saying that, this guy's got more returns. I was sitting at a coffee table and this HNI I was speaking to has made 30% where I've made only 22%. I need to move more towards equity. I think this is the anathema of long-term compounding gains. And this is what is required. A more amount of sensibility is required.
Yes. Which brings to the next question, and I think quickly is, for the sake of time, is on real estate. So I think if you really look at the last decade, real estate, I think, went through a rough patch from, I think, 2012 onwards. And then RERA and a couple of things happened from a regulatory side. And then probably from end of 2019 onwards, you've seen some traction coming in real estate and industries coming back to life. So my question is, do you see a lot of money which is in physical real estate actually moving into financial assets via, AIF in different categories like category 1, 2, and 3? Do you see that trend happening?
So it's a very interesting thing. I was reading something about real estate the other day. It seems that, even 10 years ago, people were looking at real estate as a very aggressive growth vehicle, and a lot of money went into real estate, sometimes for the wrong reasons. Okay, when RERA came in, cleaned up the entire thing. But just prior to COVID, there was this whole disorientation towards real estate. Millennials were saying that why do we need to invest in real estate? We might as well stay in a rented house and this and that.
Yeah.
I think COVID changed all of that.
Okay.
Post-COVID, now there is this view that not only do we need a roof above our heads, okay, but maybe if we already have a roof above our heads, we need an extra room. You know, we need to spend more time with family. We need to do a lot more at a personal level.
Right.
So real estate has got an impetus. A lot of people now want to buy property. So I wouldn't say that buying real estate or financializing real estate is the only way. You need to look at real estate if it makes you comfortable. I always say that comfort is more important than conviction. Right? So if it's gold which gives you comfort, have some amount of gold. If it's real estate, have some real estate. But the fact of the matter is too much of a good thing is also a problem. So now to access the gains which real estate can make for you, one of the ways to do it is a real estate debt fund.
Okay.
So wherein we have a high yield fund, it's called Sundaram Real Estate Fund, Real Estate Debt Fund. It's a private credit fund in which you lend to developers.
Okay.
Now typically where money has been lost in the past is when you give money to a developer and he goes and buys a land bank. Whenever you buy a land bank, more often than not, it has got political hues.
Right.
Okay. You never know when the land bank might actually translate into gains in terms of a property.
Right.
Risk return wise, it's highest risk, highest gain. Right? But it does not always translate that way.
Right.
Now, what a fund like ours does is it actually borrows. Let me just correct myself. It actually lends to borrowers who are vetted by our ecosystem,
Right.
okay, against guarantees,
Right.
for their projects, against cash flows. So we will never lend it for something which is greenfield. It will usually be brownfield.
Okay.
So you will usually have 2 or 3 projects hypothecated to us, senior secured charge. You will have cash flows which are into an escrow account. That has turned out to be a very profitable sort of avenue for AIFs for their investors. So investors on an average make far higher returns than they would make on any other private credit avenue simply because it's getting into real estate. How we've mitigated this entire thing is we lend only to builders in the south currently. So it's a micro market risk. See, unlike any other asset class, each state will have their own risk nuances attached to real estate. For example, we will not go into NCR and Delhi. That's clearly mentioned in our PPM because we believe that is a risk we don't want to take in our portfolio. But south, we are there. We will not lend for, unless and until, of course, it's a builder whom we know, for land banks.
Right.
We will not do that. So these are the things which are mitigated risks. And we've had a fairly successful track record, close to 50 transactions, close to 3,000 crores worth of assets deployed, recycled. This is our 4th fundraise. And like I said, Sundaram has a skin in the game here. The group has invested money here, as well as the fact that the whole IC of Sundaram Home Finance is on the board of this AIF, which will change the way people look at real estate.
Right.
We are one of the few entities which is trying to assiduously change the perception. There have been real estate AIFs in the past, for one reason or the other, which I mentioned, have struggled.
Right.
Okay. We have learned from the mistakes and made little less of our own, which is why I think this is turning out to be something which is getting more acceptable. To circle back to your question, does it make sense to invest in real estate debt funds? Yes, it does. With reputed names like Sundaram, it does. But one has to still be a little wary because real estate is still not at that level of disclosure or liquidity that most other asset classes, including gold, today have. You can liquidate gold through an ETF immediately today, right?
Yeah.
So,
yeah, and really, if I may add, my personal sense is just to add to that is that you will always have physical, residential and commercial real estate.
Exactly.
But really, if you want to, if your investor is really savvy about real estate, then AIF is really a way to look at a managed portfolio. Whether you're looking at, like you're talking about, a portfolio. And most of these are through a special purpose vehicle. You participate, you have 4-5 builders who have certain repute, and then you leave it to the professionals to run that fund. So that's the best way to participate in that bucket because obviously you won't have the bandwidth otherwise to do it. So clear takeaway for the viewers is that yes, leave it to professional fund managers like Sundaram Alternates to run your portfolio piece. And even in real estate, there are several nuances. You could look at pure, interest income coming where you're lending to your borrowers. And then I've seen other asset class emerging, rental yield trees.
Yes.
So you're going to have a different structure to the portfolio. So
warehousing,
warehousing is something we've been talking about.
That's the fun part today of being in India in the alternate segment. There's a proliferation of ideas, and also there's a proliferation of capital which is willing to back those ideas.
Yeah,
you're absolutely right.
So, which kind of brings me to the the other part, and this a little. How do you see? Do you see that Sundaram Alternates will be coming out with any new product launches in the next couple of quarters? So anything for our clients, for our viewers here?
Yes. Like I said, this is a very active ecosystem out there.
Okay.
So there are tons and tons of products which we can launch. We are looking at playing to our strengths. Okay. Today, for example, if I want to pick and choose any product, I can do that. But I would rather go deep in terms of something which we understand. And go broad in terms of categories which I think I can handle. So private credit, we are going broad.
Right.
We had real estate debt, then we've got performing credit.
Yeah.
We are looking at another performing credit fund which is at a slightly lower yield.
Okay.
We're looking at a debt PMS. So there are quite a few things we're looking at. We're looking at an offshore product, although that is still being discussed and debated right now.
Okay.
And I dare say we're not the only ones.
Right.
I think this segment is opening up. Traditionally, you will find that a lot of attention gets taken away by equity because people understand equity. Like they say, every second person in this country is basically either a Bollywood, cricket or equity expert. But I think the reverse is true for private credit or for debt. Not too many people understand debt. They find it very difficult to digest, boring, which is where I think if you apply your mind and try to find out what is the best suited for clients. So we actually married with a lot of research. We talked to a lot of wealth managers. We give them 4 or 5 ideas saying that what do you think will be best suited for your clients? Ultimately, an AIF is just 1,000 clients, right? So you have to appeal to a particular strata for getting that done. And in that, we get a lot of inputs also. Can you do this? What about this? And to be fair, the regulator is very, very open about this. The regulator has given a very sort of liberal sandbox, whether it's SEBI or whether it's IFSCA in Gift City. That just makes things that much more dynamic and exciting. So yes, we are looking at a few things, and these are the things we plan now. Basis market research, basis feedback which we get from our investors and wealth advisors, we will be looking at launching this. Looking forward to the next financial year, where there's going to be a lot of action in the alternates industry as well as Sundaram Alternates.
And this brings to an interesting point, and you brought a very interesting analogy, and I just want to take a few seconds on that. Is that everybody seems to be savvy about Bollywood and equity in country, and it just suddenly comes to my mind, and I was in one of these workshops, in one of these AMC workshops, and the concluding remarks by the CEO was to all the advisors, distributors who were there, is that if there is one thing you want to do, the end of the day, is start having fixed income in allocation to your client portfolios. And it was a very powerful remark. Basically, everybody was just talking about equities, but yes, in this whole noise of equities, we forget fixed income, and it's so much important. And we're seeing a big portion of the clients.
That's a very important point. Thanks for sharing that. I'll probably use that in some of my
so I strongly believe personally that it's not about return, it's just about completing the allocation to your client portfolio. So fixed income, just for our viewers, is important. Do not ignore that. Absolutely. And how you participate in that, we've been discussing that all throughout. And which brings me to the last and concluding part of this series, is that obviously now you're at the helm, you're driving the entire alternate asset strategy for Sundaram Alternates in the country. My question to you is, what is your vision for the business if you look at over the next 5 years, 10 years? And what are some of the steps you're taking as an organization to grow this piece and make it more competitive over the decade? Just your ideas, how you're looking at it as a business leader.
I see this whole business is about, if you talk to people will say that the alternates business, like any other business, is about ideas and execution. Correct?
Right.
There are lots of ideas going around. I might throw a few into the melting pot. My team might reject some of them. Absolutely. They might come up with some of them. But the key is execution.
Okay.
Right. How well do we deliver what we commit to the clients.
Okay.
And what I believe, that is what Sundaram does well. It's called the Sundaram experience. We call it the Sundaram experience.
Okay, that's a very Sundaram experience.
It's the Sundaram experience.
Okay.
People come to us expecting something.
Okay.
They expect returns,
Right.
but they expect us not to be too cowboyish about it.
Yeah.
They expect us to be very stable. They expect us to be very transparent.
Yes.
Okay. My endeavor is to basically layer the Sundaram experience a lot more in terms of what we do.
Okay.
How we communicate, how we market ourselves, how we
Right,
train
right.
our people. Because the moment of truth is not a fact sheet which somebody reads. The moment of truth is when you interact with that particular person, whether it's a salesperson or an operations person or an investments person. Okay. And how well are you able to articulate your narrative? If the narrative is going to be about performance, for example, you're going to get stuck somewhere or the other. If the narrative is going to be about process, people might think that you're not focused on returns, they're just focused on process.
Yeah.
It cannot be either or. It has to be the experience.
Experience.
And that is what my biggest endeavor is. I am very aware of the fact that this is a huge legacy which has been built over the years. Okay. And lot of people trust it. So the biggest thing and the biggest responsibility I have as the head of the organization is to make sure that I deliver the experience and just make sure that the values which we have, we uphold them. And I mean, just stay the course.
Great.
Returns will come, returns will not come. And I would like to use the concluding remark, people invest when they're comfortable, not when they're convinced.
Yes.
It's my job to make sure that the external as well as internal world is very comfortable. We sleep well at night.
Right. And if I can just conclude it, it's the key word for our viewers is experience, the values. I think that's a key word here. And I must share with you that whenever I'm talking to clients for Sundaram as a group, the one thing which resonates with them, they always come to Sundaram as a group from a position of trust.
Correct.
Right. And I think that resonated so well in one of the key points you mentioned in terms of the experience and the values. And I think if we are on that, this thing. So thank you so much for your time today. And it was, thank you for taking your time from your busy schedule to for this meeting. And for our viewers, just the concluding points which we can do is that alternates is definitely an emerging asset class of the decade, and we must participate in that, keeping in mind the client's risk profile, time horizon, and return expectations. I think if we can kind of do all of this holistically, then all the allocation would be good in the client interest in the long run.
Not to mention, you need to have a good advisor like AKC Capital. Okay.
That's so nice of you. So thank you so much once again, and we'll be back again with another insightful series soon. Thank you so much.
Thank you so much for having on the show.
Thanks for your time.